Hello, 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 hello. Welcome to Radio Free Wall Street. And I have an announcement to make. We've been running this show for many years, like 20. And I have to change our time slot, and let me tell you why. The reason is that we produce the show live at 5 o'clock New York time and stream it on our network. And what's happening is because of the increase in trading we're doing, and by the time I get settlements and by the time I finish up my important news releases and stories, I'm running behind. So we're going to start doing this show live at 6 o'clock New York time instead of 5, and that will give me another hour because I've been running a half hour to an hour late, and those have been around for a while know the trading comes first. So by moving the show to 6 o'clock New York time, that gives me a better time slot, and also puts the 3 hours behind the show because I have noon is a daily trade update. 3 o'clock is the market news and commentary, which concerns news, obviously, of market interest. And then Radio Free Wall Street is a 3 o'clock show, which I tend to be on one theme and pick a theme of the day that I regard as significant. So, obviously, the daily trade update, market news and commentary goes to a more exclusive audience. And Radio Free Wall Street goes to a wider audience as something I feel I must do to warn as many people coming about the economic collapse. I know that most people don't take it seriously. And it's that old thing, if it's free, it's worth nothing. But I know my conscience is clear because obviously I am planning, along with my subscribers, to cash in big time, as we've done many times before, as you know, on these market wipeouts. It's funny, many people claim to do what we do and know what we know, but we're the real deal. But in this age of circle marketing and likes and all that campaign, the masses have no way of knowing what's true and what's not, but you guys do. So ignorant people get, traps for fools, I think is the way it's been phrased. And, the market is definitely that, and many people get fooled. There's nothing you can do. We can walk ahead. We can try to save as many people as possible. But the reality is that this is a time when most people will be fooled and most people will be wiped out. Depressions always do that, as you know. And the theme of this show tonight is I want to deal with the fact that the Fed, for years, has felt, especially in the 2006, 7, 8 wipeout, that has saved the market. In the past, the Feds would have let more banks fail and more institutions fail, and it was a Keynesian experiment. And the theory was during the 2007, 8, 9 wipeout, the financial side of it was that they would bail out all the institutions. And any financial institution of any size in trouble received bailouts, and we're talking about $10 trillion. And it's 10 years later, and the Fed is finally liquidating the assets it bought to provide liquidity to the system. It is now removing liquidity from the system that that as interest rates going up. And it's committed itself to a interest rate increase every quarter. So that's 4 a year. And we're looking at 5, 6 quarters in the future of Fed funds rate increases. And that takes it up another 1.5 points. And this is the way they get kind of air under the market. Now, in quiet circles, it's been pretty much, the analysis is done, and pretty much it realized that bailing out the financial institutions didn't work. The idea was that they did not want to reward bad behavior, but they had to bite the bullet and provide liquidity to the system because it wasn't tolerable for them to have the financial system collapse. I want you to understand that. Now, I'm of a different opinion. Having been an entrepreneur, a businessman, I understand, and all over the world, and you've been very successful trading, thank God. It's a gift. I call it the gift of trades. Each trade I'm in that's successful is another gift, is how I regard it. And the lesson I've learned is that, damn it, as hard as it is, let dead broke institutions go broke. Do not reward bad trading behaviors. I trade, and you trade, and we risk the market, and if we make money, we make money. We don't make money, we don't make money. That's just how the world works, okay? The problem is that when you reward bad behavior for the banks, when these big institutions have no consequences for what they do, and they know they got a backstop by the Fed Reserve, that promotes more bad trading. In other words, The problem you're trying to solve is, stop doing stupid-ass trades. Stop taking incredible risks. Stop hiding losses. And the idea is to force the markets to respond to discipline. And that if a trade is a bad trade, it's a bad trade, and you take a loss. The situation where government gets involved in bailing out bad behavior in the marketplace has created this aura of risk-taking in financial institutions that is beyond what they were designed to do, okay? Banks are not really designed to be risk-takers. They should not be speculators. And by allowing them to do that, you create a situation where, again, there is no accountability. They get away with doing very bad things. They constantly increase their bad model, and you put the financial system more at risk. See, the idea was that the financial system can't afford institutions taking big risks. So the whole idea behind the legislation from the Volcker Rule and these other things was to take risk out of the system and set up institutions that were at risk but not using depositors' money. But the trillion-dollar banks with the huge banking lobby basically neutralize most of the rules, and banks are more at risk. The risk instruments I'm talking about are derivatives, credit derivatives, and they're swaps, and they're structured debt, and they're all kinds of instruments that we collectively call derivatives. And derivatives is actually a casino. It is still not regulated. There is still not disclosure as to counterparty risk. Banks can use little special entity corporations that they own so they can show the ownership of the corporation. But since the corporation is outside the regulatory environment, that special purpose entity risk is not disclosed. So it's unknown how much risk they're taking on. The financial system had $500 trillion in derivatives. That's now to between 800 and 900 trillion. Listen to this. There's not even good accounting about how big the derivative casino really is. It's still unknown. And what's happened is the risk banks are taking are greater than ever before, and we're on the verge of the wipeout. Now, let me tell you what the big difference this time is. The Fed Reserve is letting it be known that they're not going to reward bad behavior. They are not going to bail out banks this time, and they are not going to gear their operations to watching the stock market. The Fed Reserve goes through myths. It depends upon which doctoral laureate and economic professor of note happens to be popular at the Fed and who they listen to. And one of the opinions was, well, what was good for the stock market is good for America. Now, at one time, the markets believed what was good for steel was good for America. And then it was what was good for General Motors and the car, that was when they were like 68% of the global car market was good for America. And then it was what was good for the stock market is good for America. And then it kind of melded into what's good for the big banks is good for America. Now there's great realization that none of those entities and pandering to them and subsidizing them by way of the Federal Reserve and rescue them is good for the economy. Chrysler was rescued, 2 times, 3 times, and eventually got bought out at fire sale prices by a foreign entity. So the lesson's been learned that the U.S. economy is more complicated than big banks. The U.S. economy is more complicated than the stock market. And the stock market does not necessarily represent the economy because of the way the indexes are set to region manipulate. Right now, the stock market rally you're seeing, that's 5 key stocks, okay? It's basically a high-tech rally that is being driven by stocks that have been grossly overvalued, stocks that have never made a profit for the most part, stocks that, like Tesla and these other entities, that need a constant inflow of cash in order to survive. And the reality is that they're remarkably broke companies. And again, it's a situation that most people don't realize. Most people don't understand is being subsidized. So as American debt approaches 100% of GDP, the Fed Reserve realizes that, well, it's not the stock market. The best way we can keep these systems going and keep these systems functioning is to make sure that U.S. debt markets are deep, meaning they have many instruments, and rich, meaning paying high yields, and liquid, and that the global market understands that no matter what happens, American debt will be paid. Depression, bank failure, stock market crash, business slowdown, bankruptcies galore, political strife, no matter what, American debt can be relied upon 1,000,000%, and so will be the U.S. dollar. So that means that the Fed's emphasis is taken off of the health of the banks. It's taken off of the health of Wall Street. It's taken off of the health of businesses, and that the emphasis is because of the new debt paradigm that we are only going to look at guaranteeing sovereign debt. We're going to make sure that no matter what happens in America, and with some of the questionable things that are happening coming, that American debt can be guaranteed. And it's really a brilliant thing, because let me tell you why. No matter what happens, if you have a debt market that will buy your debt, no matter what happens, if you have people that will loan you money, then whatever crisis you have in your economy, because you have liquidity, because you've got the Fed and the Treasury's ability to borrow money and fund U.S. government, that things keep ticking along no matter what. So Wall Street cannot be reliably counted upon to fund. And part of the crisis we're in America right now is that because of really low interest rates, Wall Street did not judiciously fund things. So you have, for example, a stock market bubble that's created by vast amounts of borrowed money by corporations. You have a real estate bubble, whether it's commercial real estate, high-density apartment real estate, condominiums, or single-family homes that are grossly overvalued beyond people's ability to really pay for them because there was so much debt creation. And that by removing the discipline of a wipeout, removing the discipline of failure, what you've done is you've increased the risk-taking and you've made the market more dangerous, okay? And that's the realization. So the Fed is basically letting you know that it's no longer worried about what is going to go on in the stock market, and that the most important thing it can do is allow failures to happen, and there are going to be them, and the most important thing it can do is make sure that the U.S. debt market from the Treasury is liquid and financed, and a market that everyone around the world understands will be paid. As long as you can maintain a strong currency, well, you don't have the inflation. Most people don't understand inflation, okay? Inflation is basically a currency function, okay? Debt creation is money creation. The more debt you create, the more money you create. Now, you get to a point where that mechanism breaks down, where you've created more debt and more money than your economy can use, and you now have massive debts that can never be paid, and massive money chasing it. And that's why you see in these economic crises in third world shitholes massive inflation. A good example is Turkey, which has a 100% inflation rate, okay? They are just absolutely in a debt crisis, and what's happened is no one trusts their paper. The Turkish crisis is really one of the collapse of the debt markets. People don't believe the debt will be paid, and they're demanding sky-high interest rates. Well, when you got an interest rate that is sky high, 20, 30%, then what happens is that high interest rate creates inflation because your currency becomes less worth. Now, America has shown that by properly managing our debt, by issuing paper that will be guaranteed to be paid, by having a strong currency, that American debt can be counted upon to be there, and that America can be, the dollar is the greatest currency in the world, and as long as you have a strong dollar, as long as you pay your debts, as long as your financial systems are working, then they'll put up with Donald Trump, they'll put up with trade wars, they'll put up with corporate failures and bankruptcies, because they know their money is safe and guaranteed, and they're willing to loan you more money. So the Fed is now signaling, and rightly so, that a bailout of the banking system is not going to happen this time, and that the Fed is going to allow dead broke institutions to go broke. In a Fed study, they categorized the financial institutions of America. In essence, they lumped them all what you call banks, including investment banks, including neighborhood banks, including everything that goes under the category of banks. And their conclusion was there were 5,000 banks in America, and that in the next wipeout, 3,000 will fail, and that should be allowed to happen. Now, that's a market change in the philosophy of the Fed and how they're approaching this thing, and the reason why is two things. One, although you can't publicize it to the masses, they know recession's coming. I mean, the one thing the Fed should know is that there's cycles of boom and bust, and that there are recessions in America, and every once in a while a recession becomes a very big event called a depression. And the Fed has learned the lesson that it is wiser to let the wipeout happen, let the financial institution collapse, because it costs too much to finance them, it costs too much to try to keep them in business, and in the end they fail anyway. That's one huge change you understand. So you're looking at 3,000 financial institutions to fail. Now, they won't exactly call it failure. They'll be merged and purged out of existence, but huge financial loss will be taken. Now look at the stock market. Well, if you look at the stock market from a historic standpoint, it's a ridiculous bubble. I mean, the market has just soared to the moon, and the reality is that although it soared to the moon, the valuations aren't there. In other words, the justification for prices of the market really doesn't exist, okay? And that's what we call a bubble. And that this bubble stock market is going to end in a disaster. And the truth is that let's suppose the Fed really wanted to save a market. They can't. So what's the solution? Well, you let dead broke institutions wipe out. You allow stock markets to crash. You allow people who made bad decisions on their investments go broke. Millions and millions of Americans have thrown their money at what I call the retirement fund industry, okay? That's the Fidelities of the world. That's these funds that are these huge, complicated entities that use retirement calculators that trick people into giving them money. And they do it under the fear that, well, you're not going to have enough money for retirement if you're in boring investments, so you've got to go in these special investments we offer you that pay you more money. Now, I want to be very clear here. The only place for retirement savings is in non-investments. In other words, once you are investing your savings, once you're trading your savings, once you're in funds, you're no longer saving, and now you're investing and you're speculating, and your money's risk. So there's only two places for retirement savings: cash in your mattress and in U.S. government securities. Now, the reality is that, and again, these fun guys I want to tell you, is that U.S. government securities you can buy from Treasury Direct. And the reason why they don't want to tell you about them is they don't make a commission, and they lose control of your money. Okay, Treasury Direct absolutely will be there. TreasuryDirect.gov, G-O-V on the end, and you can set up an account, and you can put your money there, and it's guaranteed. And the reality is that interest rates are now so high that people are stuck in a situation where investments didn't make any money, so it didn't pay to mess with it when returns were a fraction of a percent. You know, you actually had long-term investments offered by the private sector that paid 0.80 to 1%. You can buy U.S. government 10-year bonds, 10-year, at a little over 3%. And although that 3% doesn't sound like much, it's a phenomenal return, and it's returning more than the yield on the S&P 500, okay? Without any stock market risk, without any crash risk, because guess what? The stock market is due for a crash. Now, we're in rally mode in the stock market, and this rally is pretty impressive. 10 years of basically a straight-up market, something unparalleled. In fact, the rally's been so long and so high that traders are no longer fearing the market. We have what's called the VIX indicator, also known as the Fear Index, and that measures how much option buying and people are using to protect their portfolio, and it's at lows never seen before, okay? The VIX index is traded the least it ever has in history, and it represents the fact that the market knows no fear. Now, when you get to the point where market knows no fear, that means risks are huge, And when you get into a high-risk profile market, well, that's a market's going to wipe out. Not a unknown situation, not a maybe, but a reality of how markets work. So we're now in a situation where risk abounds. Understanding of the risk is not there. The Fed that was backstopping the market, I got your back kind of thing, is not occurring. And reality is market participants have taken huge risks that are not documented, risks that are not popularly accounted for, and risks, listen to me, that they're not compensated for. In other words, because these rates are so low, you are not receiving, when you take high risk, the yield you should be getting to protect yourself. So there's no incentive to do it. And millions of people with billions and even trillions of dollars in retirement savings will discover that the way they got that retirement calculator to work was by taking huge risks, and they're now rolling snake eyes. The risks are not guaranteed. There is no backstop. There is no protection. And the reality is a lot of people on Wall Street and the financial institutions knew they were taking huge risks, and what they were counting on is the fact that they would get a bailout. And the reality is there's no bailout coming. This time they will be allowed to fail. The wipeout is upon us. And 10 years of incredibly stupid risk-taking is over with. 10 years of people doing really stupid things will see a price to be paid. And the way I put it is those chickens will come home to roost. And it's going to be a really ugly situation. And many people will be shocked at how much money they're going to lose, and shocked at how ugly it's going to be. And many people that are prosperous will be wiped out. And again, that's not a popular thinking. That is not something that is in the psyche, and many people don't believe it. Now, those who've been with me a while know that we've had many wipeouts, and many people get wiped out and don't recover. See, you don't hear about the people who got wiped out in 2007, 8, 9. You don't talk about the people whose portfolios wiped out. The stock market always comes back. Well, you and I know that it comes back because you throw the losers out of the popular indices like the S&P 500. You throw the losers out of the NASDAQ. You throw the losers out of the Dow. And then you replace it with companies that are growing and healthy so your index recovers. The problem is that people that invested in the dogs of the Dow, in the losers in the S&P 500, and losers in the NASDAQ, don't have the luxury of throwing them out. They have their money in them. So the index reflects only a stream of winning stocks and no consequences for loser stocks, while people invest in the market don't see their portfolios coming back because they're buried in the losers that went broke and are no longer in the index. It's one of the dirty little secrets, and no one talks about it. The other thing that happens is that, if you wipe out and you take a bankruptcy at 20 years old, who cares? At 30, going bankrupt at 60 or 70 and losing retirement savings means that you don't have the time to recover. So as you become older, you should become less risk averse. Now, I'm a big believer in risk taking. I think risk, highly leveraged risk, is one of the greatest gifts of capitalism to the common man, okay? He can trade the same instruments as billionaires can and take risk on leverage. That's a great way to wealth, but that can only be undertaken with risk capital, because if you're taking a high risk where you're going to make a huge return, well, you are chancing making a huge loss. And the fact of the matter is most people that trade highly risky instruments lose 80% of the time. Okay? Well, that means that people who are good at this, that 20%, make the money from the other 80%, okay? So that means that the risk to reward is phenomenal if you understand how to do this, if you have the right tools, the right advice, the right market orientation. And again, it's a matter of understanding risk, quantifying it, not overtrading, dealing with it. And one of the biggest mistakes people are making is that they're taking extremely high risk, and instead of getting hundreds and hundreds of % return, they're taking high risks by giving the money to someone else. And the way that works is they take a really high risk, and if they make money, they throw you 1 or 2% extra. Okay, so where you're making 3%, you're paying 5. The other side of it is that if and when those risks go bad, those bad loans stop paying, the principal's not returned, well, guess what? You're now taking a loss. So basically in most funds, or most retirement funds, you're taking extremely high risk with highly leveraged instruments, with companies that are paying you a premium because they don't have access to capital, and the odds are they won't pay you back. And you're doing so without getting the benefit of the return. So that's why I hate those instruments. I hate those vehicles. So what's happening is people are taking extremely high risk, and they don't get a reward for the risk they're taking. And when things wipe out, they get wiped out. So you're taking all the risk, not getting the return you should be, and eventually when they roll snake eyes, it's sayonara your money, you wipe out. And like I said, those who've been with me a while, you well understand that. Now, there was a feeling in the marketplace and a belief that government would bail out these institutions, that government would come to the rescue. And that was reinforced by, the bailouts of 2007, 8, and 9, and the wipeout that started in 2006, by the way. But the reality is that the risks that these entities took that caused the 2007, 8, and 9 wipeout, those instruments are still on the books. Those risks are still there. They were just pushing forward into the future. And now we're coming up on a second day of reckoning, okay? In other words, it's the same wipeout in slow motion. So with the cost of trillions of dollars, the markets bought themselves 10 years. And 10 years of incredible subsidies by governments, 10 years of basically free money for the big guys, 10 years of more bad deals is going to end up in the biggest stock market wipeout ever, because guess what? All you did was postpone the date with destiny. You haven't changed the portfolio. You haven't changed the matrix of the risk management. All you have done is allowed them to buy time, and because government was bailing them out, and because they felt that they had a guarantee, they did not lower risk, they increased it. And the regulations that were supposed to be going to prevent this from happening again, the reality is that the banking lobby stopped those rules from being put in effect, and now under the Trump administration, there is no safety net, there is no increased capital, there is no lessening of risk in the marketplace. In fact, just the opposite, it's gotten a lot uglier. So we're now in a situation where the marketplace is going to deal with the fact that we're headed for another recession. Fed is raising rates, which means that companies that are subsidized by very low rates lose that. We are in trade wars, which is stopping business. We have the Fed raising rates, which is flattening the yield curve, which will make it go negative, which takes liquidity out of the system. So we're headed for a recession. But this recession means that most people are in it because they were under pressure for a high yield, and only a blessed few were smart enough to get in U.S. government securities. And what happened, U.S. government securities were paying such a low return that people forgot them, and people didn't get into them. I find it amazing that as I put people and say, look, you need to go in 10 and 20 and 30-year paper and zero coupon bonds for your core wealth. And right now, you're getting 2.25% on a 2-year note, and every quarter they're going to pay you 0.25%, a quarter of a point more. Every year, the yield you're going to get is going to go up by 1% in short-term paper, which means now it pays to be there. Now it pays more than the high-risk retirement funds they're trying to get you into. Now you're being rewarded for your risk, and your risk is almost non-existent in safe, secure U.S. government instruments, and you're going to be punished for high risk. So the blessed few people who are in Treasury Direct that have their money in U.S. government securities will be richly rewarded for their diligence and for their patience. And people who want to be the high rollers and bought into this retirement calculator bullshit are going to find that the money's not going to be there. They are not getting paid for risk, and that those instruments that had a backstop of the Federal Reserve bailouts is no longer there. The banks will not be bailed out. The money market funds will not be bailed out. The mutual funds will not be bailed out. The corporate debt that's going to go bad will not be bailed out, and nor will the stock market. So we are on the verge of the biggest financial collapse ever. We are on the verge of huge amounts of money that is about to be lost by individuals like something never seen before. And we're on the verge of an economic crisis. And the Fed has let it be known they don't have the markets back. They're not going to backstop the economy. They are not going to bail out banks and financial institutions. This time, dead broke banks will go broke and stay broke. People that have money in mutual funds and all kinds of retirement instruments that have made bad loans to Venezuela and Brazil and Argentina, and have got bad loans in Latin America, have got bad loans in malls and shopping centers that are emptying out, will pay the price. So I want you to know that. So that means that you need to understand that there's three parts of your financial world. One is the super safe, secure, which is your core wealth that's not in real estate and is not in debt instruments that will not be paid back, but in instruments of the United States government, guaranteed by the United States government, but guaranteed by the almighty dollar that will always be there for you, okay? And those instruments will represent a fantastic opportunity to make a lot of money. Safe and secure and guaranteed to be there, okay? And that's the government money and Treasury Direct. Now, there's a second part of your portfolio, and that is money that is in speculating in the market. That's money that will be in stocks and ETFs and those kind of instruments. That is money that is at risk and a calculated risk, okay? And that's the second part of your portfolio. That's not your retirement savings. That is speculation. That is money that is at risk in the marketplace, and hopefully you're making wise decisions to be compensated for the risk you're taking. Now, there's another group of money, and that is your highly speculative, highly leveraged money. Now, this is money that is destined for stupendous returns. Now, what's happening with you, if you're not careful, is you're taking stupendous risk without instruments that offer you the stupendous returns. Somebody else is in between you in those investments. Now, if you get into a situation where you're the one that's making the money and you're taking the risk and you understand how to do it and you got the proper guidance, these can be the most lucrative things you can do. They're also the highest risk. But high risk has a place in most people's portfolio if you understand it's high risk, if you understand the risk and make sure that you get rewarded for taking that high risk, and that you understand what you're doing. And that is another factor in the marketplace that, again, people are not understanding. People are not being compensated for. And at a time of a wipeout, if you have instruments that make you money when markets go down, when stocks crash, when debt goes bad, then you have a phenomenal opportunity to make what's incredible returns. And we're just at such a time. So the problem is that most people are not being rewarded for their risk, don't understand their risk, and do not have their portfolio divided up correctly. And the only non-risk instruments are a cash in your mattress and U.S. government securities and Treasury Direct. Anything else in any other entity, in any other profile, is at risk. And the real reality is, let me say this to you, the vast majority of Americans in retirement saving funds from the Blackstones and from these Vanguard funds are not being properly rewarded for the risk they're taking, okay? In other words, they're chumps. They're taking extremely high risk and no returns. And we are at such a time when a huge number of instruments of debt, that's high-profile debt, will wipe out. And if you understand that, then you can position yourself to make one hell of a lot of money in the coming stock market crash, a hell of a lot of money in the coming real estate wipeout, and a hell of a lot of money in structured debt and all CDOs and all kinds of instruments wiping out. Now, if you're at the point where you're still at naive stage, where you don't believe the wipeout's going to happen, I can't help you. I'm sorry for you. If you're at the point in life where you don't understand it and you have faith in these money market funds, these mutual funds, and these dog shit investments that have no guarantee at all, then I want to say to you that God doesn't forgive your stupidness. God will not reward you for being ignorant. And you will get the life you deserve, which will be one of abject poverty, if you don't understand that we're headed for a recession and a depression. And by the way, double on that if you're being fooled by a man like Donald Trump.